Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this video, I want to discuss Apple. Is it a little bit too overvalued right now? Should we be investing in it now or should we wait? You're going to want to watch this video. So Apple has been on a major uptrend. You see here from October 14th, it's been in this channel and it just broke it, getting as high as 165. And it really just fell into that hype of EV news with Rivian and Tesla just getting so much hype lately, and them announcing that they're going to make an automated vehicle. Anytime the holiday comes in, they sell so many iPhones. So big holidays, they're estimated that they're going to be selling over 40 million iPhones from Black Friday to Christmas, and even larger, double than that internationally. So Apple, when we talk about is it undervalued, it depends on what type of investor you are. For me, for example, like when Best Buy dropped to 105, I felt like it was at a great value. I had an intrinsic value of 128. So I bought Best Buy at 105, and within 10 months or 7 months, it jumped up to 135 and I got out. Made almost 30% on that one transaction. So for me, I'm looking to make 15 to 20% per year on my stocks that I buy. So that's a different type of investor. I'm going to buy stocks, sell them. If it dips, I'm going to buy. If it reaches my intrinsic value, I'm going to reevaluate and maybe sell some of them. But if you're just a investor that is looking for a few ETFs, a few good stocks to invest in and to hold for the next 20, 30 years, of course, Apple is going to be great at this price. Even here, they're going to continue to be relevant and they're going to continue to grow. But this is more for, we want to just look at the intrinsic value and see if it's worth getting in now if you're that type of investor. So Apple, there's no doubt about their fundamentals. Their revenue has been growing every year, year over year. Their free cash flow is great. They do have quite a bit of debt, but they have a lot of cash flow also. And as far as catalysts, they have constant catalysts coming out with their iPhones, new iPhones coming out, with their vehicle now. But we have to go back. I mean, they've been talking about a car for quite a while. In 2016, they estimated that they were going to have their vehicle by 2020. So we're still kind of waiting for that hype to happen. They're talking about partnering up with BMW, partnership with Hyundai, but none of those have come to fruition yet. They've also discussed coming up with a battery with a Chinese firm, and they've pushed back and they fired some teams, and some of their management has quit. They've received some of the management from Tesla, where Elon commented and said that's basically a graveyard for certain Tesla employees. So it's just been a back and forth with Apple and where they're at. But overall, no one's going to deny that it's a great company. Their revenue is growing every year. And although almost half of their revenue comes from the iPhone, they have been trying to kind of diversify and make some money from services, from their watches. But it's still, their iPhones are what brings the majority of their revenue. And that's why in 2018, when they had a few quarters of poor iPhone sales, their price dipped so much. So that's why, these intrinsic values are important to me, because anything can happen. They can have one bad headline, a few bad headlines, and the price there can be just such an overreaction, and it can fall to those prices that we think are way far off, and you get in for a great deal. And then I'm looking to get in at a discount. So as far as their car, they have to partner up with somebody. I mean, there's already competition. Tesla has competition. And if you think about the type of vehicle that they're going to create, the average vehicle right now is about $45,000. They're probably going to have to create like a higher end, more expensive $60,000 type dollar vehicle. So they're going to limit the market that they're going to be able to reach. And as far as competition, Tesla's already looking to have 4 factories within the next 2 years, with the potential of being able to make 1.5 million units by 2022. Rivian and Lucid are looking to make 250,000 units annually over the next 3 to 5 years. So Apple would definitely have to partner up with somebody. And, there are some estimates that if they are able to enter the EV race, that this could add potential $30 per share of total addressable market. But that's so difficult to estimate. I mean, there's so much, it's so hard to scale up with a car company. That's why it's not, I don't think it's going to work unless they partner up. And if they partner up with someone and announce it within the next year, this price is just going to go crazy. But we're going to give a fair value. We're going to base it off of their free cash flow and see what we think this company should be valued at based off of their free cash flow. So if we take the base case, we're estimating a 20% growth, 9.7 discount rate. Their current free cash flow is $73 billion, and we believe it's going to grow to $87 billion here for the base, then 105, 126, 151, 181. Get the terminal value, and we get the enterprise value, subtract financial liabilities plus cash, and we come up with a fair value of 113. Now, I think these numbers are extremely realistic. I think they've proven already how much they've been growing in revenue. If we look at their income statement, they've gone from 58 billion to 53 to 91, 64, 111, 89, 81, 83. So they've shown that they can grow their revenue. But if you aren't at that bullish and, your worst case scenario, 84 billion, 97, 111, 124, and that would give it an intrinsic value of $90. And if you believe that they're going to continue to grow, if they're going to take market share. So right now, okay, this 162, is it the value of the company, or is there a lot of hype for the potential of the holidays, the potential of the EV vehicle? I think there's some hype mixed in this price. I don't think it's all just in, what the value of the company is. But if you are extremely bullish, if you feel like they're going to continue to grow and you want it to buy now because you're giving the best case scenario, which would be 22% growth, 89 billion, 109 billion to 198 billion, then the intrinsic value would be $186. For me, I would like to see it drop down to maybe 120, 110, somewhere. I think somewhere between worst and best case scenario for me, honestly. If there was an overreaction, and it's possible, if you go back to some of these stocks, I mean, they climb up, and then they crash 10, 15%. Sometimes there's great opportunities. If we look at the whole tech sector, there's a lot of companies that are doing well, as far as free cash flow and intrinsic value, but they've recently just had major drops because of the whole tech sector is dropping. Look at PayPal, was trading as high as 311, now it's down to 185, right? So let's just say a person up here at 309 did a DCF and they felt like, okay, now this company is trading at 300, but I think it's worth 190. And, you may look at this person and say, okay, 308 to 190, that's just like crazy. Like, why are you giving it a value of that? But look, it went all the way down to 186. So right now there's people that maybe, and I don't know what the intrinsic value is for PayPal, but maybe let's just say all those investors that had it set at 190 or 200, maybe they're going to start buying it and then maybe it'll reverse. Fiverr is another company that has a lot of potential. And it's just, if we look up here, look, it was trading at 336. And maybe there was someone that did a DCF at that point and they said, you know what, I think it's worth 150. And now it's all the way down to 143. Big drop. It's a good company. They have opportunity. So coming up with, with Apple, if it's all the way up here right now, 161, and I'm saying, you know what, I would feel more comfortable buying it at 119, 118 area down here. It's possible that it can come down. And if it doesn't, then you miss out. It's fine. But if it does, like PayPal, like Fiverr, and there's other examples, then you're buying yourself a company that you believe in. You believe that's going to be around for the next 20 years, 15 years, and you're getting it at a discount. And that's the difference of different type of traders. There's day traders, swing traders. As far as investors, there's value investors that are looking for these overreactions. They're looking for this fear. That's why Buffett would buy when there was fear. And trying to get these companies at a great discount, companies that you believe in, companies that have solid fundamentals, that they're not going anywhere, like the PayPal, like Fiverr, like Apple. I just don't think these companies are going anywhere. But if you're just a regular type investor, you have some sort of app like M1, I have M1, and you just want to put $100 every week or every couple days, and you want to just pick a couple of blue chips type stocks, the Apples, the Microsofts, a couple of ETFs, and you don't care what the price is, and you're going to hold it for the next 10, 20, 30, 40 years, then I still believe you're going to be profitable, of course. But I'm looking for that window. I'm looking for that drop, getting this at a great discount, and then increasing, doubling my revenue. Just like I did with Best Buy, and we have the video there. It dropped to 105. It hit my scanner. I was like, oh, I did an intrinsic value. I thought it was a great discount, and it went up to 135. That's almost 30% on just one stock. So if I can get anywhere from 15 to 20% on stocks, over the years, you're doing a lot better than the S&P. So that's my strategy. Thank you for watching. I hope you enjoyed the video. Don't forget to subscribe, comment, and like, and see you on the next video.